What's up, everyone? It's Scotty with Money Investing. So we've got a big FOMC meeting scheduled for July 26th at 2 p.m. Eastern is when the statement from the Federal Reserve comes out, and 2:30 p.m. Eastern, of course, is when the press conference begins. So this is a meeting which is not going to be accompanied by an SEP, Summary of Economic Projections. But in this video, my goal is to basically go over what the expectations are from the market and also what some of the economists are saying. There was a 45 Economist survey that was published recently. I'm going to go over that as well and share my expectations and how the markets might end up reacting to what the Federal Reserve is going to do and say. So I hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below, and we'll love to have you on board. There is a 16% annual discount that gives you access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the intrinsic value spreadsheets, private videos, trading view charts, tutorials, and a lot of other educational benefits as well. So link's going to be down below. And I'm happy to share that we have also launched our options course, first ever options course. So that's going to be available for everyone to join as well. Link's going to be down below, coupon code LAUNCH. And that there's a 50% discount at the moment that we're offering. So again, link's going to be down below. You're welcome to join and learn how to generate passive income and cash flow through selling options. It's going to be a very, very conservative strategy. I'm not here to, go over how to make hundreds of thousands of dollars. Sure, that's going to eventually be the focus and the goal. But this is a conservative strategy that requires, discipline, that requires having an understanding on these conservative strategies of selling calls, puts, and running the wheel strategy, understanding Greeks, understanding risk management, trade management, rolling options. There's a lot of lectures and tutorials that I've spent hours building and creating, so you can check out that down in the link in the description below. So this right here is going to be those expectations for the meeting in July. So July 26th, next week, is the big day. 99.2% probability that we're going to see a 25 basis point hike. And then the market's pricing in that we're going to see a pause and no more hikes remainder of this year. And in fact, cuts beginning next year in March of 2024. And 5 cuts putting us down to 4 to 4.25%. That's what the market is currently pricing in at the moment. Now, of course, we know the Federal Reserve has been anything but in line with the market, because there's been a big discrepancy, as we have talked about throughout 2023 and even most of 2022, how the market is certainly pricing in something completely different than what the Federal Reserve has been telling us. So if you take a look at what the Federal Reserve has been telling us, they put the federal funds rate at 5.6% in their most recent Summary of Economic Projections. This came out in June. So for 2023, they're pricing in 5.6% as a federal funds rate. And then, of course, cutting that down to 4.6%. However, the market, if you come back, is looking at 5.25 to 5.5%, which is going to be 10 basis points lower than what the Federal Reserve told us. And of course, cutting it down to 4 to 4.25%. So longer and bigger cuts is what the market's pricing in, and lower terminal rate is also what the market's pricing in. So there's still a couple discrepancies left, but we have come a long way. We've come from, 11 cuts and a terminal rate, which was sub 5%, to now finally getting up to over 5.5%. But right now, we're still working with 2 discrepancies. That is to say, the market is only pricing in one hike. Federal Reserve's told us at least 2, potentially. And 4 cuts is what the Federal Reserve's told us, and market's pricing in 5. So those are some things to keep in mind. Now, this right here is, I believe, from Bank of America. Now, I could be wrong. Actually, this is from Goldman Sachs. So Goldman Sachs, they mentioned that a 25 basis point hike is fully priced in for July FOMC meeting next week. The key question is how strongly Chair Powell will nod towards the, quote, careful pace of tightening he advocated in June, which we and others have taken to imply an every other meeting approach. And that's true. The Federal Reserve and Jerome Powell has told us that this is going to be a meeting by meeting decision depending on the data that's coming in. And inflation has been moving in the right direction. We know that there's been a lot of disinflation in the economy. Used car prices, food prices, energy prices, food and used car prices. In fact, actually food is in disinflation. Shelter is in disinflation. We know that energy and used car prices are very much in deflation because they are declining on a year-over-year basis. And they go on by saying that we expect Powell to cautiously avoid implying that the FOMC has already reached agreement, but are confident that he does want to slow the pace and that the FOMC will end up skipping in September. Incoming information during the inter-meeting period has been mixed implications for Fed policy. On the dovish side, core CPI inflation showed slowed sharply in June, and what we think will prove to be a turning point in the inflation story. On the hawkish side, activity data continue to show that the demand growth ran above potential in the first half of 2023, and financial conditions eased a bit further as well. So it is quite an interesting dynamic because we do have a very strong economy, right? We do have an economy that is consistently growing. GDP numbers, by the way, come out next week as well. We've got the labor market that continues to be very, very tight. So we've got a very strong economy with a very strong jobs market. What does that suggest? That suggests the Federal Reserve has more flexibility to continue to raise rates. They can continue to increase their terminal rate, of course, continue to do 25 basis point hikes here, and the economy can continue to withstand that. So far, it's played out to be true because, like I said, economy is strong, the jobs market strong, but at the same time, there is going to be a lag effect. There is going to be at some point during the second half of 2023, at least in my opinion, where we are going to start to see some of these lag effects come into fruition. That is to say that all the rate hikes that were done in 2022 and most of 2023 will start to play a bigger role in the credit quality, in the credit circulation in the economy, and of course in the jobs market as well, in consumer spending, in business spending, in business investments, and of course cost of borrowing that continues to go higher and higher. Furthermore, they say that we expect a hike next week to 5.25 to 5.5% to be the last of the cycle, but on a probability weighted basis, our Fed views remain more hawkish than the market pricing. And I think I'm in a very similar boat here. This reflects both of our lower probability of recession and our expectation that the threshold for rate cuts will be fairly high and that cuts will be gradual. We expect cuts to start in the second quarter 2024 to proceed at 25 basis points per quarter and to end with a funds rate at 3 to 3.25%. Above the FOMC's 2.5% longer run dot. So what they're really saying is that they are a little bit more on the hawkish side, and probability weighted basis, there is going to be a lower probability for a recession, and the threshold for rate cuts is going to be much higher. So as I mentioned before in one of my previous videos, if you guys did watch it, what did we talk about, right? The Federal Reserve needs an incentive. They need actually a motive to cut rates. If they don't have a motive, they don't have an incentive, they're not going to cut rates. Every time you look back in history, they've cut rates with a purpose. There needs to be a purpose for the Federal Reserve to cut rates. If there's no purpose, they're not going to just wake up one morning and be like, you know what, let's just cut rates today. That's just not going to happen. And the purpose comes with a recession or deflation. Those are the two primary reasons. There's some other external purposes like, political pressure, some other, government office or body wants them to cut rates. I'm not going to get into that because, again, that's a bit of a political debate. But the two main reasons, two main incentives and motives for the Federal Reserve to cut rates is recession and deflation. We have neither. So in my opinion, at least over the foreseeable future, my expectations are 25 basis point hike next week in July. Higher for longer, so staying there, continuing to monitor where inflation goes. If shelter starts rolling over, fantastic. 70% of the CPI basket is going to be in deflation, as Tom Lee also mentioned, and that will once again solidify our expectation of a soft landing, and the Federal Reserve can start looking into staying at those levels, so pausing and then potentially cutting rates next year if one of those two things happen, if the economy enters a recession with all the lag effects, as I mentioned earlier, or if you see deflation with respect to inflation, or both. If both happens, fantastic. I mean, the rates are going to be like literally down to 0% again, and you can expect a lot of stimulation in the economy and growth stocks to absolutely go to the moon once again. But that's going to be the motive. That's going to be the incentive. That's really what the purpose needs to be for the Federal Reserve if they are planning to cut rates. So going over to some of the Economist surveys and basically talking a little bit about what their expectations are. So most economists expect the Federal Reserve to lift interest rates one more time next week as it ends the 16-month hiking cycle that has been most aggressive fight against the U.S. inflation in 40 years. So there was let's take a look here. So survey of 45 economists was conducted between July 13th and July 18th. And the Economist survey expect the Federal Reserve to keep rates at their peak level through the end of the year, so staying higher for longer. And they are split on whether the first cut will come in January of 2024 or not. Many participants, the median number of participants, also believe the first cut is going to be in March of 2024, with rates falling to 4.75% by the end of June 2024 and ending at 4.25%, which I think is a little bit higher than what the market's pricing in. And the projections are slightly higher than in the last month's survey as well. And by contrast, Fed officials in June forecast rates falling more gradually to a range of 4.5 to 4.75% by the end of 2024 as well. And James Knightley says inflation is still set to slow sharply, but interest rates cuts, which we have long been expecting, are unlikely to happen before the end of this year. And that's primarily because of the reason that They need a reason, right? That's the reason why the Fed rate cuts are not a high probability outcome, is because they need a reason. They need a purpose to actually be able to do that. So very, very important day next week, July 26th. I think we're going to get a little bit more insight into the policy path and what the Federal Reserve is expected to do. In my opinion, I think the market are slightly weighted to the upside. And the reason I say that is because 25 basis points is not going to make or break the economy anymore. We've already gone through 500 basis points, 525 basis points. Another 25 basis points is not going to be crazy for the economy, for the market, for inflation. We've already gone through with so many rate hikes. And one more thing that I wanted to mention. Yes, so the one thing that I wanted to mention additionally was the Federal Reserve is, even if there is a hawkish narrative to what they talk about with respect to one more additional rate hike, I think the market for the most part has already priced that in. So if you think about it from based on all the probabilities here, if the Federal Reserve raises interest rates by 25 basis points and gives us a dovish FOMC conference, market has a higher probability of going higher. If the Federal Reserve and Jerome Powell gives us 25 basis points and is very neutral in their narrative in their press conference, again, market has a probability of going higher. And even if the Federal Reserve ends up being hawkish, 25 basis point hike, and gives us another opportunity, let's say that they say that maybe there's another potential hike coming in the future, September, October meeting, that also is what the markets have already priced in. We already have learned that from the SEP. We've already learned that from the June meeting. So if you look at all the different outcomes, the market definitely are weighted a little bit better to the upside going into next week than they are to the downside. Of course, if the Federal Reserve comes in and says inflation is nowhere near close to our target, we're going to continue to raise rates, we don't have any set timeline as to when we're going to pause, then obviously that once again creates a lot of uncertainty that leads to a lot of questions for the Fed, and that scenario alone could be a little bit more bearish and create some downside for the markets as well. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. Don't forget, new options course available, 50% off, coupon code LAUNCH if you want to take advantage of that as well. So always happy investing. I'll see you all in the next video.